looking for the sports channel.
Alrighty, well, this video will be the official debit spreads video. A lot of you guys have been asking me for a debit spreads video. I use them a lot. I live off of debit spreads here at Weenie Trades. After this video, you're probably going to stop buying calls and puts super far out of the money. You got to be smart when you're buying options, and you really need to know what you're doing. And if you learn a little bit about debit spreads, you'll realize why just buying naked calls and puts, you really got to think the stock is going to be exploding in your favor. If you haven't seen the first video, check out Double Your Money with In-Out Spreads here on Weenie Trades. In-Out Spreads are just debit spreads, but I also sometimes call them vertical spreads. As you'll see, they're called vertical spreads in TD Ameritrade. But vertical spreads, debit spreads, whatever you want to call them, I'm going to be giving a few examples on Thinkorswim, and I'm going to be giving a few examples on Robinhood. So as I said earlier, I live off of debit spreads here at Weenie Trades. If you check our Robinhood account, I mean, we just have tons of debit spreads everywhere. You know, we live off of these things. We use it for hedging. We'll buy put debit spreads if we have a lot of positive deltas, meaning our portfolio will go up when the market goes up, but we want to hedge that off a little bit. We buy some put spreads where we might be bullish on a stock and we'll do some call spreads. We have some in-out spreads, lots of stuff. We'll even talk just a little bit about put credit spreads, how it's still bullish. And there's just a ton of ways to go about it. You can profit off of any move in the market. I love debit spreads because they're great for swing trading. It kind of smooths out the volatility of it that other than a naked option. They're lower cost than naked options. So because they're lower cost, you're going to get a little bit less reward, but not always, as you'll see in some scenarios as I'll give. It has a slight directional bias. So if I'm buying a call debit spread, I want the stock to go up. And if I have a put debit spread, I want it to go down, but it doesn't have to be a big move like it needs to be with naked options. What's great about debit spreads is your entries do not have to be perfect. Have you ever bought a call or a put and then the stock immediately goes against you and you're down immediately? Well, with spreads, you can have a lot more wiggle room when you're getting in. You cannot have the best entry and still make a good profit. So as long as you have time on your spreads and you chose your strike prices correctly, which I'll help you figure out, they're great. Debit spreads are great for if you have a target, as we'll go over the Apple example. I don't think Apple's going to go past 130 in 2 weeks. So because I don't think it's going to go past 230, that's why I'm going to be doing a debit spread on it instead of just buying a naked call. And it's also great for just getting some exposure to big stocks. I mean, we can trade things like Google and still make, good profits, $69 profit open. We'll talk a little bit about this, but we can capture big stocks without using a lot of buying power. I mean, I'm only using $100, $200 to get exposure of upside to Google, when normally I'd have to, if I wanted to buy shares of the stock, that would cost $1,823. Or if I wanted to buy a naked call, that's going to be expensive. That's going to cost $1,370. If you want to go in the money, you have to spend $4,000. So debit spreads really reduce the cost and let you capture those big stocks and capture those big movements. And what's great about debit spreads is that they mature at expiration, kind of not before like a naked option. So we'll kind of talk about that in a bit. But if you buy a naked call, you can get your profit right away and nice and early. But with a debit spread, they mature at your expiration date. So let's go over a few examples. Our first example of a debit spread is going to be on Apple, and this is going to be on Thinkorswim. So as I said earlier, I'm pretty bullish on Apple. Once we broke above this kind of resistance area over 122, 123 area, I went ahead and bought a debit spread right about here. And so what I did was, instead of just buying a naked call, instead of just buying like I said, I think it's going to go to 130. That would be the breakout to another kind of pivot. This is going to be like a good resistance zone. So I don't think Apple will go past 130. So why wouldn't I just buy like a 130 call or a 129 call? Well, because I want to get in the money. Getting in the money is always the goal when you're buying options. And so you're still buying options overall when you're doing a debit spread. So what we did was we bought the 129 call, but at the same time, we sold the 129 call. I like to use the option chain on Thinkorswim always for making my decisions. If you want to see how to customize this, you can customize and you can add whatever you want. But what's really important is looking at the probability of touching. What's the probability that the stock will even touch that price by the expiration date? So look at the probability of touching. There's a 68% chance that Apple's going to touch 125 by December 18th. So I really like that. So I'm going to buy that option. You know, there's over a 50% chance that we're going to be at 126 or at least touch 126. There's over a 50% chance that we're at least going to touch 127. So I really like this spread because I'm buying the 125, I'm selling the 129 call, meaning I'm capping my gains at 129. If Apple just rips up to 150, then yeah, I should have maybe bought just the 130 call and maybe buy the 130 call expiring, that's $65. If Apple goes up to 140, that's going to be about $1,000 of profit if Apple does that. But I don't think that's going to happen. So I might as well reduce my cost a little bit. So if I were to buy just the 125 call trade price, that would have cost me $217. I don't want to pay $217. I only want to pay like $100. So at the same time, I sold the 129 call. I collected $100 up front, but I have to say, I have to sell my Apple at 129, which is fine because that's where we wanted to sell it anyways. So because of that, I have this little graph over here, and these show what the debit spread will be worth. So I paid a total of only $100 for the spread. I would have had to pay $200 if I just had the 125 call, but I only paid about $100, maybe like 105, 110, something around there. So our max risk is $110. So let's take a look at this graph over here. So if we look at the graph, if Apple on expiration date, so 12/18, December 18th, if Apple closes at like 126, the spread will be worth about $150. If Apple closes at 129, 128, it'll be worth $300. If Apple closes at above 129 or, a little, even anywhere up above that, the spread will be worth $400. So if the spread will be worth $400 and I only spent $110, that's a profit of about $300. So $300 if Apple can get through there. Had I just bought the 129 call and then Apple closes right at 130, I'm barely making any profit. I might even lose money. So it's the difference between making money as the stock goes up and just losing money. When you're buying a naked option, you need it to go far past your strike price if you want it to be worth your time. And so the debit spread really lets you capture that big upside move, and you're limiting your gain, but that was at your target anyways. So the risk is built into the spread. So hopefully Apple gave you a good little taster of the debit spreads, but let's go over another one, but this time through Robinhood. So Tesla, I'm pretty bullish on Tesla. I think we're probably going to break out over this 607. We had a really strong bullish close on Friday. And so what I did was I actually added a little bit to Tesla, but I've been swing trading it ever since, the 570 area. So if we go to Tesla, let's scroll over to our Tesla spread that we have purchased. So this is a live example of what we have. We have what's called a 615/620 debit spread. And so what this means is I have the right to buy 100 shares of Tesla at 615, but I have to sell my shares of Tesla at 620. Shares, options land, multiply by 100. What's the max that we can receive? Well, the max that we can receive is $500. So if we enter in 5.00 and good for day, good till canceled. If I just want to collect the max profit, boom, min credit, that lets you know that's the max I'm going to receive. I'm going to receive $500 off of a cost of $160 if Tesla can close the week next week above 620, at 620, above 620, in that general area. So this shows the kind of graph that we're looking at. And so Tesla, that's our debit spread. If we look at the naked options individually, look, we have the 615 call, one buy. Look at this, it's worth $1,616. If I wanted to just have a naked call, and I think like Tesla's going to really explode, because if you just have a naked call, you need the stock to explode greatly in your favor. So you really need to be targeting a big, big, big move. You need to, that's what premium buyers are doing it for. So this would have cost me $1,616, but since I didn't want to spend $1,616 at the same time, I sold the 620 call. See, look at that. That's hedging off some of my theta. And look, I collected $1,456. So what's my total cost? Only $160. That's the difference between the spread that I paid. The spread. You see how it goes. So Tesla, it's a great way to capture a big stock and a big movement. And look, my risk is only $160. The risk to reward is built into the spread. I'm risking 1 to make 3 about. So that's kind of the Tesla trade. Since we were pretty bullish on it, let's take a look a little bit more something advanced, but we sold a put credit spread at the exact same time. So I wanted to collect some premium. So normally a put debit spread would be you buy the 572 and sell the 570, right? If I was bearish on Tesla and I think Tesla's going to go to 570 or even just a little bit lower, I would buy the 572.50 and sell the 570. What's the most I could receive? $250. What would I pay? $80. So my max profit is about $170, somewhere around there. But instead, I took a bullish trade and I actually sold this credit spread. Instead of paying $80, I actually received $80. So I'm receiving my money up front. We'll do another video on our credit spreads. But as long as Tesla stays above that 572.50 area, I'm going to collect $80 next week on Friday. That's going to be for another video, but just another way of thinking the inverse of the trade. Just as the inverse of my debit spread on Tesla, I could sell this spread and collect $160 up front. But what's my max risk? $340, right? $340 because that's the most that we can make. So there's two sides to every trade. How bullish are you and how much are you willing to spend? Keep the risk in the spread. Let's go through one more example and I'll be showing how you purchase this debit spread on Robinhood. So we're pretty bullish on Target. Target just had a nice good cool off and it's now forming a hammer candle. I'm looking bullish on Target, so I want to capture some upside. But I don't think Target's going to go very high. I don't think it'll go past 200, maybe by the end of the year, maybe by next year. But let's open up a debit spread to kind of capture where I think Target might go. If I think Target's only going to go to the previous, breakdown resistance of, 177.80, we can set up a trade for that. You could like buy the 175, sell the 177.50. Boom, there's your spread. Or let's go a little bit further out in time and let's see if we can capture this range all the way from maybe 190 to 200. Because remember, we want to get in the money and then the strike that we're selling, we want it to be out of the money. So let's do a debit spread on Target. So let's type in TGT, Target. This is on Robinhood. And look, Target, we can go and we get trade Target options. And let's say I think it can do it maybe by the end of the year, but let's say maybe in March. In March, I think Target will be at or above 200, but I don't think it'll get much further than 200. That's the thing. It can go past 200 and you can still be just fine. It just takes quite a while. So let's buy the 195. Look at that. Buy the 195. Total cost, $440. I'm cheap. This is Weenie Trades. I don't want to spend $440. Let's be a little bit more capital efficient. I don't think it'll go past 200, so let's sell that call. We have the right to buy it at 195 at this expiration day, March 19th, 2021. But let's sell the 200 call. Well, look at that. Our total cost just moved down to $100. So it only costs $100. And if Target is at, let's say, 195, let's remove this. So over here, we have the right to buy it at 195, but we have to sell our Target at 200, which we're okay with. That's where we wanted to sell it anyways. We're building the risk and the trade within the initial cost. So that's what this will look like. If in just a few months, Target will be at 190, above 195 and at 200, I'm going to collect the full $500 credit. Because remember, 200 minus 195, that's a $5 wide spread. In options land, multiply by 100, and boom, that's where you'd receive $500. But look, we spent about $100, $103. That means our max profit is $400. Well, what if Target closes at 199? Well, then you just shave off $100 from the top, so it'd be at $400. What if it closes at 198? Then it'd be at $300. What about 197? That would be about $200. And let's say Target hits 200 at the end of the year, earlier than our expiration date. Because remember, these spreads mature at expiration day. If Target goes up to that 200 earlier, let's say it does it next week, the spread will not be at $500. The spread will probably be something at about $250 or $300. You have to wait till the expiration date. You have to wait till the expiration date to receive your full credit. And so it turns into that kind of that credit spread, which we'll make another video about, especially if you have a little bit more questions on that. So hopefully that helps you capture, get a good idea. That's kind of the range we want to capture on Target. So some tips when you're building these debit spreads: buy the call you think it will hit. Remember, we think it will hit 195, but we don't think it'll go past 200. Sell the call that you think the stock won't hit. And remember, you can do this on the downside too. Maybe you're bearish Target. Maybe you think it'll come down to 150. You could buy like the 155 because you're sure it'll probably hit the 155. And then you could sell the 150 put. So that's kind of your put debit spread. Remember, the risk to reward is in the spread. So if we're going through a ton of these examples, look at this Disney, let's look at this Disney 210/220 debit spread. This expires in 2 years. You can do it with time as well. The cost is only $37. Keep the risk in the spread. All I'm risking is $37. And if in 2 years Disney is above 220, I'm going to collect the full. What's our max that we can make? Let me know. It should be what? $1,000. So, because 220 minus 210 is $10 in options land, multiply by 100. Boom. $1,000 is the most we can receive if Disney is above 220 by the expiration date. I think this is still a great deal. You get 2 full years and Disney to go up just, another $50, $60, $70. So that's the power of the debit spreads. Another tip on the debit spreads is buy spreads on liquid stocks. I'm having even a little bit of trouble on Google. Look at the spreads on Google. The spreads are really wide. And what I mean by the spreads of the spreads, not the debit spreads, but the bid-ask spreads. So look at the bid, look at the ask. That's always a decision I make when I'm making the trade. The bid is at $1,370, so $1,370. The ask, the sellers, are at $1,560. That's a wide spread. So when you're doing, you need to get filled on multiple orders. So it's going to be a little bit tougher. You might have to pay up on some of these spreadier stocks like Google. But if we go over to something like SPY, the S&P 500 ETF, it's really liquid options. It has the most liquid options in the world. If we go over to the trade tab, look at the bid-ask spreads, 195 by or 395 by 399. That's a nice tight spread. So you could buy vertical, because remember we're buying a spread. We're buying +1 the 370, selling the 371. Look, this is an in-out spread. Paying $50, the most we can make is $50. The most we can lose is $50. Because look, it's right there in the middle. Right there in the middle. The option, when it's right there in the middle, that's your risk to reward. That's your probability. 50% probability of profit, 50% probability of loss. And that's because SPY's either going to go up or down from this point. So that's what happens when you buy it right at the money. Another great tip is Robinhood is great for spreads. There's no commissions, so you're not going to get lose a lot of money to slip. You'll lose a little bit of money to slippage, but the fills are getting better on Robinhood. TD has commissions, so TD is great for the fast fills if you need to get filled. Maybe you need to get a quick entry. Maybe you think the SPY is going to break down and you need a quick put spread. You can enter it a lot easier on Thinkorswim, and you'll pay that little bit of commission. So be sure to go with the wider spread so that the commissions don't eat up your profit margins. So be sure to cut your spreads if you think your debit spread won't hit. Let's say I don't think this Starbucks 104, 105 will hit by next week. I do think it will, which is why I'm still holding it. But if I didn't, I would just go ahead and close the spread. Maybe I have to close it for, minus 50%, which remember, keep the risk in the spread. I'm keeping them nice and small. Look at this. I paid $26 for this. 105 minus 104, that's $1 in options land, multiply by 100. The most we can receive for this is $100. That's the most we can receive. But if I wanted to cut it, I just have to, sell it for maybe like $19 or something. If Starbucks gaps down, and I don't think it'll go past 104, past 105. So that's kind of another good tip. So, keep it in there. So if you don't think it'll be in the money, cut it. But if you do think it'll be in the money, hold it. Sometimes some spreads can really mature. So for example, Qualcomm on Friday, we had a spread that we cut and we shouldn't have cut because I was looking at Qualcomm. I was like, man, it actually probably can hit that 157.50. And it went on the day just from, $5 all the way up to the max profit of $250. So remember to keep that in mind when you're doing the spreads. Always remember that the probabilities are in the spread. If you don't risk enough, you could be correct on the direction and still not make money because you purchased a spread too far out of the money. So you can still purchase spreads too far out of the money, just like you wouldn't want to purchase a naked call or naked put too far out of the money. It's just like this, the SPY 365, 364 puts. You could buy this for $5 if you really think SPY is going to sell off. I think this should be worth a little bit more because the market can really drop pretty fast in some points, but you wouldn't want to buy this spread because you're only paying $5. It's saying that there's only a 5% chance that you're going to, make money off of this. So why even buy it? But I mean, maybe the risk to reward is what you see favorable. Don't go too far out of the money. The probabilities are in the spread. Remember, if I were to pay $50 for a spread and a $1 wide spread, that means the probability is 50%. So now I'm just going to quickly go over some spreads that I have. So I have this Disney 152.5, 155 spread. This is an in-out spread because look, I paid 125. Look at the spread, 155 minus 152.50. That's a $2.5 wide spread. The most we can receive is $250. We paid $125. So what's the most that we can make? Well, about $125. And we just need Disney above 155 by next week. Disney's at 154.13. So this spread should be hit as long as Disney can mature and the market can hold up. And what's the risk? The most we can lose is $125. I'll probably cut this at about minus $50 if Disney starts to drop. And so let's just kind of go through. Sometimes I have spreads that are a little bit separate. That means I created the spread not at the same time. So for example, on this AMD call, we sold the 99 call, but we had first owned, never sell a naked call unless you own the shares or something, which really I guess isn't really selling a naked call. But look, we bought this 96 call for $205, but after AMD pushed up a little bit, we did a ghetto spread and we sold the 99 call. What's the max we can receive? 99 minus 96, and that is $300. And so the most we can make is $300. What's the most that we're risking? Well, since we bought the 96 call for $205, that's a lot of money. I didn't want to have $205 wrapped up in AMD. So what we did was we sold this for $129. What's the difference? That's about $70. So we're risking about $70 and we want to turn it into $300. What's the most we can make? Well, just about $220. So tons of different spreads. You can do leap spreads. You can do in-out spreads. Definitely a lot better if you have a target in mind. The only time to buy naked calls is when you think there's about to be a big breakout and it's about to be sustained and you want to hold it and you're probably going closer to the money. We did that with Starbucks. We normally don't do naked calls, but this called for it. We had to move up, sideways consolidation. I'm in balls to the wall naked calls because we're going to get a breakout and a little bit of range expansion. Still would have made good money on the debit spreads, but probably not as much as our naked calls. So figure out whether you need to do a spread or if you need to go naked, but it's the decision's up to you. You can profit off of any move in the market. You can even buy spreads deep in the money. There'll be higher probability, but higher cost and lower reward. So hopefully this gave you a little bit of a tutorial on debit spreads. They're super important. They're my bread and butter. And I don't think you should be trading calls and puts. I think this is actually where most people should start, although it's a little bit of an advanced topic if you don't fully understand options and how they're the insurance market. They're constant. The market is completely efficient. You need to understand your deltas, your Greeks, and everything like that. So let me know what you thought. Let me know if you have any questions in the comments below. Let me know if you want to see a credit spread video or any other type of video involving options, because you can truly profit or hedge yourself against any move in the market with the options market. It's an insurance market and we like to use it to profit. So thanks for tuning in. See ya.